Understanding return on average capital employed, ROCE. Return on average capital employed, ROCE, is a critical financial metric employed by investors and analysts to evaluate a company's profitability relative to its invested capital over a specific period. Unlike the related ratio, return on capital employed, ROCE, which analyzes capital utilization at a single point in time, ROCE takes the average of both opening and closing capital for a given period, thus providing a more comprehensive view of a company's performance. Key formula and components of ROCE. The formula for calculating ROCE is plaintext. ROCE equals EBIT / average total assets, average current liabilities. Where EBIT, earnings before interest and taxes. Average total assets, the mean value of total assets at the start and end of the period. Average current liabilities, the mean value of current liabilities at the start and end of the period. This formula helps analyze a company's efficiency in generating profits from every unit of capital employed. The significance of ROCE. ROCE is particularly insightful for businesses operating in capital-intensive industries like oil extraction, manufacturing, or telecommunications. High ROCE values can indicate that a company generates greater profits from a smaller base of capital investment, suggesting effective management and operational efficiency. Conversely, lower ROCE figures could reflect issues in generating sufficient returns relative to capital invested. Fundamental analysts often prefer ROCE over other profitability metrics since it provides a comparative measure of a company's ability to utilize its investments effectively. This metric becomes even more meaningful when evaluating companies with significant capital investments against their peers. Example calculation of ROCE. To illustrate how ROCE is calculated, let's consider a hypothetical company with the following financial figures. Beginning total assets, $500,000. Ending total assets, $550,000. Current liabilities, $200,000. Revenue, $150,000. Operating expenses, $90,000. 1. Calculate EBIT. EBIT equals revenue, operating expenses equals $150,000, $90,000 equals $60,000. 2. Calculate average capital employed. Beginning capital employed. CB equals total assets, current liabilities equals $500,000, $200,000 equals $300,000. Ending capital employed. CE equals total assets, current liabilities equals $550,000, $200,000 equals $350,000. Average capital employed. AC equals CB plus CE, /2 equals $300,000 plus $350,000, /2 equals $325,000. 3. Calculate ROCE. ROCE equals EBIT average capital employed equals $60,000 $325,000 equals 18.46%. In this scenario, the company achieves an ROCE of 18.46%, indicating its efficiency in leveraging capital to generate profits. Distinguishing ROCE from ROCE. While ROCE and ROCE are closely related, they serve different analytical purposes. ROCE is calculated as follows. Plaintext. ROCE equals EBIT capital employed. Where capital employed is calculated by subtracting the current liabilities from total assets at a specific point in time instead of averaging over a period. This distinction is crucial because ROCE smoothens the figures, reducing the impact of unusual fluctuations or seasonal variations in a business's performance. Limitations of ROCE. Despite its value, ROCE has certain limitations. 1. Depreciation impact. Companies with significant capital assets may appear more efficient due to asset depreciation. As these assets lose their value, the denominator in the ROCE equation decreases, leading to an inflated ROCE. This could mislead investors about a company's actual efficiency in utilizing its capital. 2. Capital structure variability. ROCE does not account for the financial structure of a company. Companies heavily reliant on debt might show higher ROCE figures due to reduced capital employed but could face higher financial risk. 3. Variability across industries. ROCE might not be directly comparable across different industries. Some sectors require more capital investment than others, making it essential to benchmark against similar firms. Conclusion. Return on average capital employed, ROCE, serves as a vital tool for assessing a company's profitability against its capital investments. By providing a more averaged view of capital usage, ROCE helps evaluate a firm's efficiency and effectiveness in generating returns. However, it is essential to consider its limitations and not use it in isolation but alongside other financial metrics to gain a clearer picture of a company's financial health.